The Dow and the S&P 500 posted their worst 3-month period since the first quarter of 2020, when COVID lockdowns sent stocks tumbling. The tech-heavy Nasdaq is down more than 20% over the past 3 months. It is worst stretch since 2008. The 20% fall of the S&P 500 in the first 6 months of 2020 is the worst half since 1970. It is led by worries about Fed's interest rate hikes, unprecedented surging inflation, China's COVID lockdown, and Russia's invasion of Ukraine. That is not a joke. The worst year in half a century tells us a lot about how bad this situation is. Even getting rid of the gold standard in 1971 by Nixon did not cause such a crisis. It is not just about the S&P 500. Look at the Nasdaq. It is having some of its worst times in decades. We've already had a wave of bankruptcies, especially in the world of crypto. If this was the end, we could have said, alright, we had a bear market and things will get better soon. But the problem is that this is just the beginning. We have already discussed in previous videos what has caused such a bubble in the last 2 years. But what is happening now isn't just about the last 2 years. The crisis is much deeper than that. The bubble that is unfolding in front of us is the result of Fed's action for the past decade, if not more. So it is not going away in just 6 months. What we have seen in the first half of 2022 is just a taste of what's coming. The Fed perfectly knows that, and it's not much that it can do, so it is trying to soften the pain. It is not going as soft as we would like to, but we should get used to it because it seems like the everything bubble is about to burst. So the question is, what is the everything bubble? How did we end up creating such a massive bubble? And how bad the coming recession will be? We'll answer all of these questions and many more. But before we do that, give this video a thumbs up and let's dive in. In January 2022, as measured by the CPI-U, inflation posted its most considerable 12-month increase since February 1982. The 12-month gain was 7.5%, up from the 7% in the period through December 2021. Price hikes for food, electricity, and shelter majorly contributed to overall inflation. That's when the Fed could no longer hide that it was worried about inflation. No matter how many more times it hiked the rates after that, it didn't help, since in February the rate was 7.9%. In March, it got worse and rose to 8.5%. In April, 9.6%. And finally in June, 8.6%. If we compare that to June 2021, that is multiple times higher, since inflation back then was just 2.1%. So what exactly happened so suddenly that things got so out of control in a glimpse of an eye? Well, nothing. Inflation has been around since the Fed used quantitative easing to save the economy in 2008. Wait a second, if you look at the data, inflation has averaged at around 2% for the past 15 years. If you are talking about consumer prices, then yes. But if we are talking about asset prices, then the answer is slightly tricky. Since the world got hooked on easy monetary policy and quantitative easing, it did everything possible to keep asset prices rising. From January 2010 to January 2022, the S&P 500 grew by around 300%. Well, if we take the exact period prior to that, from 1998 to 2010, it grew by just 4%. That's not like the economy grew much faster during that period. It grew by around 2% annually as it did before. But what exactly was different this time? The central banks across the globe, with the Fed being at the head of them, loosed financial policies so much that they gave us the illusion of growth. Yes, look at the numbers. Everything was growing really fast, but did our efficiency at that rate grow as well? No. Did we build more factories? No. Did we hire more people? No. This is the number of dollars in circulation. Until the 1970s, the amount of currency in the economy was stable. It grew insignificantly after 1971 when the US dismantled the gold standard. It did not right away print an enormous amount of cash and throw it into the economy. However, it gradually began rising. However, in summer of 2008, there was a spike. That is when the Fed threw trillions of dollars into the economy to save it. And since then, the amount of cash in the economy skyrocketed, reaching its peak in 2020 when a global pandemic hit the world. All of that cash should have created inflation, but as we have looked at the consumer price index, inflation was relatively stable at 2%, but asset prices have skyrocketed. And since 80% of the stocks are owned by the top 12% of the population, only the super rich have benefited from the Fed's easy policy. Just take a look at interest rates. From 2009 to 2015, rates were almost 0%, and the Fed began slowly rising them in just 2016. When you're given free money, it is easy to grow because you can always borrow money for free to show that you're doing great. The challenge is to make money without borrowing free money. With low interest rates, companies borrowed and invested wherever they could, even if these projects were unprofitable. But it wasn't a big deal, since even if you do not make money, you can compensate for that by borrowing more. The situation got so absurd that the European Central Bank had a negative interest rate for over 8 years. It's supposed to be the other way around. You work and create something valuable, and in return for delivering that value, you're financially rewarded. But with negative rates, you are rewarded financially just for borrowing money. So if you're not going to use that money wisely, you're not losing anything since rates are negative. Of course, that is an oversimplification because things are a bit more complicated than that, since negative rates at central banks don't necessarily mean negative rates by the time it reaches the consumer. But you get the point. So the growth that we had since the 2008 financial crisis was fueled by cheap money and multiple bubbles, such as the Bitcoin bubble in 2017 or 2020. Low interest rates also led to stock buybacks. When the price of a stock increases, we usually assume that it's because the company is performing better. It might have built more factories, hired more people, or innovated new products. But that's usually not the case. Companies use cheap money to buy back their stocks, which decrease the number of shares in the market and hike the prices. In 2020, low rates led prices to rise as much as 25%. Did houses instantly become bigger, better, or more convenient? Not at all. Everything was driven by easy monetary policy. We got so comfortable that we came to assume that investments will go up no matter what. But how can something rise when no additional value has been added? So imagine for a moment how big is the bubble we have created. Bubbles are normal since the economy goes through cycles from expansion to contraction once it reaches the peak. The problem that the economic cycles happen every 3 to 5 years. But our last expansion started around 2009 and continued until the end of 2021. Over a decade of economic expansion was driven by cheap money. It created such a bubble that we still have no clue how big it is. And now it came to hunt us down by stock market collapse and high inflation. On top of that, the crisis we are facing now has exacerbated everything. All that the Fed can do is now soften the crisis. It's difficult to say how long it will last at this point, but what is certain is that the worst is yet to come. Thanks for watching and see you in the next one.